Hey folks, the Fed's live right now. I just wanted to bring this to your attention, and there's a lot of information coming in right now. So we're going to watch this a little bit live, and I'll give you my comments as we go along. So I apologize, it's the first time I've gone live, and I just want to make sure this goes right. So bear with me 1 minute.
Economic growth this quarter. High-frequency indicators point to reduced spending in COVID-sensitive sectors, such as travel and restaurants.
They did announce they're not going to raise any rates.
May also be affected as many workers are unable to report for work because of illness, quarantines, or caregiving needs. Fortunately, health experts are finding that the Omicron variant has not been as virulent as previous strains of the virus, and they expect that cases will drop off rapidly. If the wave passes quickly, the economic effects should
Big key,
well,
if.
and we would see a return to strong growth. That said, the implications for the economy remain uncertain, and we have not lost sight of the fact that for many afflicted individuals and families, and for the healthcare workers on the front lines, the virus continues to cause great hardship. The labor market has made remarkable progress, and by many measures is very strong. Job gains have been solid in recent months, averaging 365,000 per month over the past 3 months. Over the past year, payroll employment has risen by 6.4 million jobs.
Now the Fed said
The unemployment rate has declined
about
sharply,
8 months ago
falling 2 percentage points
they
over the
wanted to
past
see
6
job
months.
growth at 1 million plus a month. So the 300,000, I don't know how he's saying that's a robust number.
Conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand remains historically strong. With constraints on labor supply, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. While labor force participation has edged up, it remains subdued, in part reflecting the aging of the population and retirements. In addition, some who would otherwise be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. The current wave of the virus may well prolong these effects. Over time, there are good reasons to expect some further improvements in participation and employment. Inflation remains well above our longer-run goal of 2%. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, and we are attentive to the risks that persistent real wage growth in excess of productivity could put upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline over the course of the year. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. In addition, we believe that the best thing we can do to support continued labor market gains is to promote a long expansion, and that will require price stability. We're committed to our price stability goal. We will use our tools both to support the economy and a strong labor market, and to prevent higher inflation from becoming entrenched. And we'll be watching carefully to see whether the economy is evolving in line with expectations.
We will be
The Fed's monetary
watching
policy actions
carefully.
have been guided by our mandate to promote maximum employment and stable prices for the American people.
AKA
As I
inflation.
noted, the committee left the target range for the federal funds rate unchanged and reaffirmed our plan, announced in December, to end asset purchases in early March.
We knew that was coming.
In
We
light of
knew
the
that was already
remarkable progress
announced.
we've seen in the labor market and inflation that is well above our 2% longer-run goal, the economy no longer needs sustained high levels of monetary policy support. That is why we are phasing out our asset purchases, and why we expect it will soon be appropriate to raise the target range for the federal funds rate. Of course, the economic outlook remains highly uncertain. Making appropriate monetary policy in this environment requires humility, recognizing that the economy evolves in unexpected ways. We'll need to be nimble so that we can respond to the full range of plausible outcomes. With this in mind, we will remain attentive to risks, including the risk that high inflation is more persistent than expected, and are prepared to respond as appropriate to achieve our goals. To provide greater clarity about our approach for reducing the size of the Federal Reserve's balance sheet, today the committee issued a set of principles that will provide a foundation for our future decisions. These high-level principles clarify that the federal funds rate is our primary means of adjusting monetary policy, and that reducing our balance sheet will occur after the process of raising interest rates has begun. Reductions will occur over time in a predictable manner, primarily through adjustments to reinvestments, so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework. And in the longer run, we envision holding primarily Treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals. In that regard, we will be prepared to adjust any of the details of our approach to balance sheet management in light of economic and financial developments. The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet, and we will discuss these matters in upcoming meetings and provide additional information at the appropriate time. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Ooh, he didn't answer much. The big focus we want to see here is when do they expect to start rolling off or quantitative tightening of mortgage-backed securities? So we knew that they were going to taper. We knew the federal funds rate's going up.
That the Fed will
watch a few questions, then we'll cut.
Every other meeting, but certainly in the past, the Fed has hiked at every meeting. So I just wanted to ask, are rate hikes at consecutive meetings on the table this year? Is every meeting a live meeting? And on that note, would the Fed consider front-loading some of its rate hikes, even if it doesn't raise every meeting? Thank you.
Thanks. So as I referred to in my opening statement,
look at the yields
it is
popping
not possible to predict
right
with
there
much
on
confidence
the
exactly
treasuries,
what path
the
for our
10-year
policy
treasury
rate is going to prove appropriate. And so at this time, we haven't made any decisions about the path of policy. And I stress again that we'll be humble and nimble. We're going to have to navigate cross currents and actually two-sided risks now. And I'll say also that we're going to be guided by the data. In fact, what I'll say is that we're going to be led by the incoming data and the evolving outlook.
I'll give you guys a read on what's going on with the MBS market right now.
Transparently. So, more to your question. We know that the economy is in a very different place than it was when we began raising rates in 2015. Specifically, the economy is now much stronger. The labor market is far stronger. Inflation is running well above our 2% target, much higher than it was at that time. And these differences are likely to have important implications for the appropriate pace of policy adjustments. Beyond that, we haven't made any decisions.
Thank you. Let's go to Victoria Guida at Politico.
Am I able to pull up my live ticker on MBS right now?
I wanted to ask, you were talking about the health of the labor market, and I'm curious whether you would characterize where we're at right now as maximum employment, and also along those same lines, obviously rate hikes on the table this year. Do you think that the Fed can raise rates, bring inflation under control without hurting jobs and wages?
Great question, but she should ask, what is why do you not anticipate the participation rate in the employment numbers? That's a key point there, because
both sides of the mandate are calling for us to move steadily away from the very highly accommodative policies we put in place during the challenging economic conditions that the economy faced earlier in the pandemic.
I don't like that. But he's trying to stay in a position where he doesn't spook the markets.
Labor market conditions are consistent with maximum employment in the sense of the highest level of employment that is consistent with price stability. And that is my personal view. And again, very broad support on the committee for the judgment that it will soon be appropriate to raise the target range for the federal funds rate. The other thing is maximum employment will evolve over time and through the course of the business cycle. In the particular situation we're in now, it may
We're going to cut off.
increase.
There's really nothing going on, but I just wanted to let you guys know it's active. If we can be of any help to you guys, please reach out to us at the rate update, 844-775-5626. Thanks for watching, guys.